Welcome to Alpha Insights. I'm Ryan. Today we're unpacking options trading basics with Jessica. Practical, clear, no nonsense. Remember, if you have questions as we go, you can ask us at stockalpha.ai.
Thanks, Ryan. Great to be here. Options are powerful tools when you understand what they actually do, rights, not obligations, and how risk flows through a position.
Let's start simple. What is a call and what is a put in plain English?
A call gives you the right to buy the underlying at a set price called the strike, before or at expiration. A put gives you the right to sell at the strike. You pay a premium up front for those rights.
And that premium, it's made of two parts, right?
Exactly. Intrinsic value and time value. Intrinsic is the obvious part. If Apple trades above the strike on a call, that difference is intrinsic. Time value is everything else. How much the market pays for the chance that the option gets more valuable before it expires.
Give me a concrete example so listeners can picture it.
Sure. If Apple trades at $170 and you buy a $165 call that costs $7.50, the intrinsic value is $5 and time value is $2.50. The math is simple, but the behavior over time gets interesting.
Right. Time value decays as expiration gets close.
Yes, and that decay theta accelerates in the last 30 days for many equities. So short-term options lose value faster from time decay.
We should talk about implied volatility. I hear that phrase all the time.
Implied volatility, or IV, is the market's price of expected volatility. It often moves option prices more than the underlying over short periods. If IV spikes, option prices jump. If IV collapses after an earnings release, option holders can lose even if the stock moves in the expected direction.
So the Greeks help you measure these effects.
Exactly. Delta measures directional exposure, roughly how much the option moves for a $1 move in the stock. Gamma measures how fast delta changes. Theta is time decay. Vega is sensitivity to implied volatility. Rho is interest rate sensitivity, and it's usually small for short-dated equity options.
People use options for leverage, income, and hedging. Walk me through each, briefly.
Leverage. Buying calls or puts gives outsized returns if you're right, because you pay a fraction of the stock price. Income. Selling options, covered calls or cash-secured puts, lets you collect premium, which reduces basis but caps upside or creates obligation to buy. Hedging. Buying puts or building collars limits downside. Each has trade-offs in cost and risk.
Okay, let's make that real. Long call example?
Say SPY, the S&P 500 ETF, is at $445. Buying a 30-day $450 call for $6 costs $600 per contract because one contract controls 100 shares. If SPY rises to $460, that call has intrinsic value of $10 or $1,000 per contract. That's about a $400 gain on $600 invested. Big return potential, but you can also lose the entire premium.
And cash-secured puts?
If Tesla trades at $210 and you want to buy at $200, you could sell a 60-day $200 put for $6 and collect $600. If assigned, you buy at $200, but your effective basis is $194 after the premium. But if Tesla collapses to $120, you still face a large paper loss. So size matters.
Collars are popular with concentrated positions, right?
Yes. For example, if you own 1,000 shares of NVIDIA at $450, buying a 3-month $400 put for $20 and selling a 3-month $520 call for $18 nets about $2 of protection cost per share. That limits downside below 400, but caps upside above 520.
Let's talk about earnings and IV. What traps should listeners watch for?
Honestly, I was a bit surprised by how often traders forget IV crush. Before earnings, IV can double, which makes options expensive. If you buy a straddle at inflated IV, you need an outsized move to profit. Sellers can capture that inflated premium, but they take on event risk. Always compare implied volatility to historical volatility before you trade.
So many pitfalls. What are the common mistakes?
Misjudging IV, poor position sizing, ignoring assignment risk, and not stress testing worst-case scenarios. Also, confusing leverage for free upside. Options can expire worthless. Treat every premium as at-risk capital and plan exits and maximum loss.
Quick reactions. What's one short rule for choosing strike and expiration?
Align strike and expiration to your objective and risk tolerance. Use delta as a rough probability guide. A 0.3 delta is roughly a 30% chance of finishing in the money.
Short one. How should someone size an options position?
Size by dollar risk, delta equivalent exposure, or maximum portfolio drawdown. Professionals often cap single option risk to a small percentage of the portfolio.
Short reaction. Any final practical tips before we wrap?
Model payoff diagrams, calculate break-evens, and run stress tests for both price moves and volatility changes. Start with defined risk strategies like spreads or collars until you have robust controls.
Great. Let's close with a quick recap. 3 key takeaways for listeners.
1. Options are rights, not obligations. Premiums are at-risk capital. 2. Implied volatility and time decay often drive short-term option performance more than the stock move. 3. Size deliberately, model worst-case outcomes, and use the Greeks to manage exposure.
Perfect. If you have questions about anything we discussed today, you can ask us directly at stockalpha.ai. We answer listener questions live. And for more market insights, head over to stockalpha.ai. Thanks, Jessica.
Thanks, Ryan. Always good to demystify options for people who want to use them responsibly.